Hey everyone, and welcome. Today, we're going to tackle a concept that's honestly at the heart of modern finance, fair value. And we're not just going to talk about it in general terms, we're going straight to the source, using the official global rulebook IFRS 13 as our guide. Okay, let's get into it. So picture this. You're the CFO of a huge company. You own this incredible, one-of-a-kind global headquarters. It's an architectural masterpiece. I mean, there's literally nothing else like it on the market. So how much is it worth? What number do you put on your financial statements? You can't just Google it. That's exactly the kind of puzzle that IFRS 13 was created to solve. You see, before 2013, this was a massive problem. Different accounting rules had their own slightly different definitions for fair value, and that meant two companies could value really similar assets in completely different ways. It caused a ton of confusion, and for investors, it was basically impossible to make real apples-to-apples comparisons. And that's where IFRS 13 steps onto the scene. It was designed to be the single, authoritative answer to this mess. It creates one framework, one common language for figuring out fair value, which means more consistency for companies and a whole lot more clarity for investors, no matter where they are in the world. All right, so to really get our heads around this, we have to look at how the standard itself defines the term. It sounds a little technical, I know, but trust me, every single word in there is crucial. We're going to break it down into its simple core ideas. And there it is. That's the official line, straight from the standard itself. Now, I know it looks a little dense, but that one sentence, it pretty much contains the entire philosophy of fair value. So let's unpack the parts that really matter. Okay, so here's the absolute key takeaway. Fair value is an exit price. It's not about what you paid for something. It's not what it cost you to build it. It is all about the price you would receive if you sold that asset, or what you'd have to pay to get rid of a liability right now, today. And this focus on the exit price, it's a complete game changer. It's a fundamental shift away from old-school historical cost accounting. So instead of looking backwards at what you paid, fair value is all about looking forward and asking, what is this thing worth on the open market right this second? All right, next up is this idea of an orderly transaction. What does that mean? Well, it means the valuation has to assume a normal, typical sales process. The seller isn't being forced to sell tomorrow because they're going bankrupt. This is not a fire sale or a distress sale. It assumes there's enough time to do the proper marketing to find the best possible price. And finally, who's actually doing the buying and selling in this hypothetical deal? IFRS 13 calls them market participants. Now, these aren't specific people or companies. It's more of a concept, a hypothetical group of buyers and sellers who are knowledgeable, independent, and acting rationally to get the best deal for themselves. It strips away any special, sentimental value a particular owner might have. Okay, so we've got the what. We know the principles. But how do accountants actually come up with a number? Well, IFRS 13 gives them a toolkit with three main techniques they can use. First, you've got the market approach. Super intuitive, right? It just asks, what are similar things selling for? Then there's the cost approach, which is different. It asks, what would it cost to build a replacement for this asset from scratch today? And finally, the income approach is all about the future. It takes all the future cash an asset could generate, like rent from a building, and crunches it down into a single value today. Now, this next idea, honestly, it's probably the most important part of IFRS 13, especially if you're an investor. The standard knows that the data or inputs you use for these valuations can vary a lot in quality. So it created a ranking system, the fair value hierarchy. So the hierarchy has 3 levels. Let's stick with our office building example to make this super clear. Level 1 data is perfect data. The price of an identical office unit sold yesterday in the same building. Can't get better than that. Level 2 is one step removed, using the price per square foot from similar buildings in the area. And level 3? That's what you use when there's no market data at all, forcing you to use your own internal forecasts, just like for that unique headquarters we talked about at the start. Level 1. This is the gold standard. We're talking unadjusted, quoted prices in active markets for identical assets. The perfect example is a stock price on a major exchange. It's objective, it's verifiable, and it's the most reliable evidence of value you can possibly get. But what if the data isn't quite so perfect? Well, that's where level 2 comes in. These inputs are still based on things you can see in the market, but they're for similar, not identical assets. So think about valuing a bond or a piece of real estate based on comparable sales. You might need to make some adjustments, but it's still anchored to real market data. And then there are the times when the market offers no data at all, and that's when you have to turn to level 3. These are called unobservable inputs. This is when a company has to rely on its own internal models, its own assumptions to come up with a value. And, as you can probably guess, this is where things get really subjective. And it's the level that gets the most scrutiny. So, when you look at it this way, the hierarchy is really just a ranking of reliability, of confidence. Level 1 gives you the most objective, most reliable valuation. Level 3, on the other hand, relies heavily on judgment and assumptions, which means you need to look at it with a much more critical eye. Okay, we've covered a lot of ground. The definitions, the methods, the hierarchy. Let's pull back for a second and talk about why any of this actually matters in the real world. How do these technical rules affect investors and financial markets? So what's the bottom line here? Well, IFRS 13 really gives us 4 huge wins. First, consistency. Everyone is playing by the same rulebook. Second, comparability. An investor in one country can actually compare a company to one in another country fairly. Third, transparency. Companies have to tell you which level they used, which reveals just how subjective a valuation might be. And finally, relevance. We get a current snapshot of value, which is way more useful than some number from years ago. And that really leaves us with a big, lingering question. Because while IFRS 13 gives us this clear framework, the world of level 3 assets is still really complex. It makes us ask, when a company is valuing its most unique assets with its own private models, where exactly is the line between objective measurement and subjective judgment? That's the tightrope that accountants and investors are walking every single day,